This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Stanley Druckenmiller is a famed and now retired trader. You can easily find out about him and his success. I highly recommend starting with Jack Schwager's Market Wizards books. Just the other day, I read a recent speech that Druckenmiller had given. There were some great quotes in there that got me thinking. Now, Stanley Druckenmiller has never held himself out as a trend-following trader. But boy, he sure sounds like one. Consider these three quotes from Stanley Druckenmiller. I learned something incredibly valuable from George Soros, and that is, when you see it, to bet big. He also adds, you don't need like 15 stocks or this currency or that. If you see it, you got to go for it because that's a better bet than 90% of the other stuff you would add on to it. And lastly, I think diversification and all the stuff that they're teaching at business school today is probably the most misguided concept anywhere. And if you look at all the great investors that are as different as Warren Buffett, Carl Icahn, Ken Lagone, they tend to be very, very concentrated bets. They see something, they bet it, and they bet the ranch on it. Let me unpack a little bit of that. Betting big. If you're going to bet big on something, you need a damn system. You need something that allows you to put the first bet on, and if it keeps going your way, to put more on. I agree with Druckenmiller in terms of diversification as taught in the business schools. But as a trend-following trader, you can't trade just one market. When he says no diversification, what he means is don't spread all your money around to so-called limit your downside and limit your risk. Choose from a portfolio of markets. Choose from a portfolio of opportunities. And when one hits, ride it. Now, you're going to take many hits on ones that don't work out. You're going to get stopped out. Those are going to accrue as small losses. But you're always in the hunt for the big one. That's absolutely 100% spot on, fantastic advice from Druckenmiller. Look at oil over the last 3 years. You could not just be an oil trader alone. No. But oil is one of the many markets, the big liquid markets that you're following that you want to capture as it goes down. Capture as it goes down on the short side. And I don't care what instrument you're using. Futures, ETFs, who the hell cares? And that betting big concept, that strikes right to the core of trend following. Because when you have a market going your way, you have to ride that MF. Yeah, I'm trying to not curse as much on this podcast. You have to ride that MF and ride it strong. You have to bet the ranch. Betting the ranch, however, doesn't mean that you're a riverboat gambler or that you're taking insane risk. No, you bet the ranch in the context of a system. And when one market within your portfolio of markets that you're following, that you're tracking, when that one market takes off and starts to reward you, you ride that sucker like there's no tomorrow. Druckenmiller knows that when he puts that advice out, the vast majority of people will never listen to him, don't care, think he's crazy. Maybe they don't think he's crazy because they say, oh my gosh, this guy's worth billions of dollars. He can't be crazy when he says this. But you would be surprised at how many smarmy little shits are sitting at home under their breath, reading those comments from Stanley Druckenmiller, a man worth billions, and thinking they know better. Maybe they do. But they've got a sure hell of a lot of work to get ahead to prove that what they know is on a par with what Druckenmiller knows. Me, I'm not so smart, and that's something I've learned from many of the really smartest guys around. They say the same thing. I'm not so smart. I just don't want to lose money. I want to manage my downside. But when one of the big ones comes, I'm going to ride it. It's just damn motivating when Druckenmiller comes out and says, this is how it is. Because if you want to verify him, if you want to find the evidence to back up his statements, if you don't just trust his opinion, you can find it. Now, you might be lazy. You don't want to do it. You don't want to do the homework. You don't want to dig in. You don't want to find the proof that backs up what Druckenmiller is saying. Hey, be my guest. Go the easy way. And for those of you that don't know, Druckenmiller had two big mentors in his life. One was at a bank where he first started trading. The second was George Soros. Hence, when I read that quote, he was talking about George Soros. He was partners. He was involved with George Soros for many decades. That was his second biggest mentor. Regardless of what you might think about George Soros' politics, his trading, his process, well, the results speak for themselves. The man has made a bloody fortune trading trends. And here's where I'm going to diverge a little. I've hinted at this on my podcast before, and I have no evidence that guys like George Soros and Stanley Druckenmiller are exactly trend-following traders as described in my world. But you can sure as hell bet they're at least kissing cousins. I don't think I've ever used the phrase kissing cousins before on this podcast, but it's apt. Which leads me into an article that I want to read verbatim today from Josh Brown. Josh Brown is with Barry Ritholtz's firm, Ritholtz Wealth Management. Josh is very active on CNBC. He's got a great Twitter feed. And he puts out writing every now and again that I catch that I sure as hell like a lot. And today is one of those. The article is titled, "Everyone is a Closet Technician." Let me read. This will be a fairly controversial post, but I'm going to say it anyway. Everyone is a closet technician. Everyone. And in a panic or a market correction, this truism is even more truistic. First, what is a technician? Here's my own handy definition. I think you'll like it. A technician is someone who cuts right to the chase and studies actual prices and behavior instead of puzzling over the causes of prices and behavior like everyone else. I have to interject and say, of course, I already know I'm going to love this article. I already know deep in my gut where he is going to go, and I like it. And what I especially like is it's the fresh angle. It's the fresh perspective. And he's putting a tent pole down and saying, hey, critics, come and get me. Continuing. Discussing causes is a much more interesting conversation, and it gets you on all the talk shows. Discussing price, the sum total of all investor fear and greed, both historical and real time, tells you the truth about what's actually going on. It does not offer an opinion. Besides, price dictates what the news is, not the other way around. Consider, if the price of Yahoo common stock was higher today than it was when Marissa Mayer first joined, she'd be hailed as the second coming of Lou Gerstner or Steve Jobs. not a punching bag whose business initiatives and party-throwing receipts are dissected in the tech press each week. If the S&P had rallied throughout 2015 instead of flatlined, we'd be throwing a parade for the plunging oil price, not freaking out over it. When Apple shares trade higher over the course of a given quarter, it is the highest quality stock in the world with a vast opportunity ahead to take on automobiles, TV, virtual reality, and the Internet of Things. When Apple falls over the course of a quarter, Apple is a too-big-to-sail, rotting old galleon with a caretaker captain who can't turn it and a crew who can't innovate in time to save the ship from capsizing. When a social media startup prices a financing round at a higher level than the previous one, it is heralded as the next big thing, a disruptor on its way to riches and glory. If that same startup does a down round, it's already dead. All that's left to happen is the exodus of the talent and the selling off of the servers. Price creates the reality for investors because investors take their behavioral cues from price and the media fashions its headlines from it. Technicians believe there is wisdom in price, that price has memory, that people who are inclined to buy at a certain price are somewhat likely to buy there again. Unless something's changed, in which case their failure to rebuy or buy more at that formerly significant price level can be interpreted in an entirely new way. What was once an area of support on a chart becomes an area of resistance. Technicians believe that trends persist in both directions because market participants act on news at different speeds and act more boldly or fearfully the longer a particular movement in the markets goes on. This is why bull markets often end with a buying crescendo in the riskiest securities. Risk appetites grow as an uptrend persists. The desperation to participate gets stronger. It does not fade gently. This is also why selling becomes more fierce when the market is at a 20% discount to its previous high than when it's at a 10% discount. How could it be even more urgent to sell down 20% than it is down 10%? Someone would ask. Going by fundamentals, it isn't. But investors only pay lip service to fundamentals. What they are more concerned with is owning less of the thing that looks stupid to own. And the lower it goes, the stupider it looks. Unless you buy into the idea that rational behavior rules the investment markets, in which case you're reading the wrong writer. I should interject. I don't know anybody with a pulse that actually believes the markets are rational in 2016. Continuing. Technicians find truth in price rather than attempting to parse the impossibly conflicted and intentionally obscured opinions of the commentariat. Technicians find meaning in the actual buying and selling activity happening today, not in the dusty old 10 Qs of 90 days ago or in the projected estimates being bandied about among the discounted cash flow analysis crowd on the sell side. But above all, technicians respect the power of sentiment more than their fundamentalist counterparts. And sentiment, after all, is how valuations actually come to be. The P and the PE ratio, or the PEG ratio, or the PB calculation. And the real calculation, the only one that counts, the P is what pays, not the E, not the EG, and certainly not the B. Buffett would tell you the B, book value, is what pays over time, the market going from a voting machine to a weighing machine. But Buffett can afford to ride it out, having permanent capital under management and an ocean of insurance premiums sloshing in over the transom every hour of the day. Most market players do not. What I'm not saying is that price is truth. Price lies all the time. Facebook can be valued at 40 billion and then 20 billion and then 200 billion inside of a 4-year time period. Which of these prices is the truth? None of them. But all of them were momentarily true until they were rendered a lie and a new truth was forged in the fireplaces of the marketplace. Sunrise, sunset, prices change, and with them the truth itself. Everyone knows this, but many have not come to terms with it yet. Or it would hurt their career to admit that buyers and sellers will pretty much lead the way, and our opinions will closely follow behind. This is how you get a chief investment strategist whose year-end price target is raised and lowered throughout the course of the year as the stock market rises and falls. The strategist starts out with a view and then tailors her view to match the reality being generated by price, or fails to do so and is eventually fired. Have a look at the commentary surrounding oil. It falls from 80 to 70, and Wall Street seers say 65 is possible. It falls to 60, and the downside target is lowered to 40. Over the last 30 days, we've seen Goldman Sachs and Morgan Stanley take their oil price targets down to 30 and 20 respectively, just as its price was slicing through the 30s on the way to its 20s. If it continues to fall, you will hear calls for oil priced in the teens. If it stabilizes and trades higher, you will see targets lifted. I ask you, which is truth then? Price itself, or the commentary around why price should be at this level or that? When analysts and strategists adjust their views, they couch their targets in the language of fundamental developments, potential events, and the news of the moment. But in truth, what they're really doing is extrapolating what's happening today into the fog of tomorrow. Another way of saying extrapolation is to say that they're betting on a continuation or reversal of the trend. Trend is a technical concept, hence, they're dressing up technical calls in the wardrobe of fundamentals and speaking in the language of the high priests of finance. Profits, revenues, cash flows, capacity, demand, market share. In the midst of the October 2014 correction, I said that the fundamentally inclined start looking at charts and levels when uncertainty strikes. Quoting myself, and I'm actually talking about Josh quoting himself, not me quoting myself. Fundamentalists will believe in technical analysis, but only temporarily. You'll hear people who analyze balance sheets and income statements start to use the term oversold, not understanding that they're accidentally referring to RSI data, something you couldn't pay them to pay attention to during a market uptrend. There are no atheists in a foxhole, and there are no pure fundamentals guys in a correction. Believe me, they're all looking at the charts, even Bruce Berkowitz. Josh continues in his article. It happens each time, and it's always hilarious. They'll deny it. The market is wrong, or these are mispriced securities. The technician is always one step ahead. The market is not wrong. It has a current set of collective beliefs that are subject to change. Price will tell us when there is a likelihood that this change is at hand. Let's get back to the why question and the fact that technicians don't waste their time with it. There's a cognitive foible common to human beings known as the hindsight bias. As investors, there's nothing we like to do more than looking back at an event that's just taken place and reciting the reasons for what caused it as though they were obvious to us in advance. I knew it all along. It was China, Greece, the Fed, the magazine cover, Obama, the rate hike, and so on and so on. Hindsight bias is a strong tendency in humans because it helped our ancestors survive on the savannah. Telling stories of cause and effect to the next generation so no one gets themselves killed trying to harvest a wasp's nest full of honey or having intercourse with a saber-toothed tiger. I love that line. That's great. Early humans who did not carry the trait to tell these stories did not pass their genes on. They were stung to death and had their genitals ripped off. That's good. You can see I did not actually read this all before I decided to read it into my podcast because I knew in the first damn paragraph that I was going to like where he was going. Maybe in these last few paragraphs I will turn on Josh, but I don't think so. Anyways, let me read that last line. Early humans who did not carry the trait to tell these stories did not pass their genes on. They were stung to death or had their genitals ripped off. We, on the other hand, did have ancestors who concerned themselves with explaining recent events. They survived and passed these tendencies down to us. After 1,000,000 years of bee stings and foiled tiger rape, we carry on the same tradition. But it's all made up. No one knows why 1,000,000 market participants thought one thing on a Monday and something completely different on the following Thursday. The fundamentalists will share their explanations and guesses with anyone willing to listen. The technicians will take these reasons in stride and focus on what is happening, not why. The why will always be much more apparent after the fact, after it no longer matters. We still don't have the agreed upon why nailed down for the crash of 29, the crash of 87, or even the great financial crisis of a decade ago. We have theories and arguments and half-truths and politically charged polemics. But price did its thing regardless. It always will. Your favorite fundamentalist is adjusting his insights accordingly. Bravo, I am jealous. What a great piece of writing. Now, my only quibble, what the hell's a technician? Who are these technicians? Some of these technicians are out there on TV telling you if a chart moves in a certain direction or a squiggly line moves in a certain direction, they can predict tomorrow. I know Josh is not talking about those guys in this piece. So I will take over from this moment and I will say, and maybe he will correct me, but when Josh uses technician in this article, I'm left with only one option: trend following. Because the only technician that would fit the mold of what he just described in that awesome article is a trend following trader. Too many of these guys that call themselves technicians, whether they're waving an Elliott wave flag or Fibonacci or whatever nonsense, that's not what Josh is talking about here. I always appreciate, even if not intended exactly, I always appreciate when a trend following manifesto comes across my desk. And this is absolutely one of those. Take the wisdom to heart. Understand the wisdom. And if you don't understand the wisdom, send me an email. I'm easy to reach. Michael@covel.com. I will gladly point you in further directions to help your education. And for those of you that already know the truth that Josh has written in that article, well, just pat yourself on the back and say, okay, I've got a pretty good outlook for the uncertain future. But once you have that pretty good outlook, the pretty good outlook that says the future is uncertain, you better come up with a plan. There's many ways one can trade price. Best to do your homework and find out exactly why trend following is number one. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.